The short-term rental industry has officially matured. The chaotic era where success was judged merely by the sheer volume of units acquired has ended. Modern acquirers, including private equity firms and institutional operators, are no longer interested in simply accumulating raw property counts. Instead, capital is deployed to acquire operational efficiency, proven profitability, and highly scalable management structures. This balance highlights how a buyer determines worth, weighing quantitative financial data against qualitative drivers, such as brand reputation and operational resilience. As buyers become more discerning, they specifically target operational drag, the hidden manual costs and internal friction points that erode profit margins over time. The most valuable companies are not built by counting units. They are engineered into defensible, tech-enabled assets long before a sale is ever discussed. The primary methodology for valuing a management company is a multiple of EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it serves as a baseline for a company's operating profitability. Within the lower middle market, these businesses typically trade for a multiple of 3 to 5 times their adjusted earnings. However, businesses that are highly differentiated and system-driven can command premium multiples of 6 times earnings or higher. Over the 12 to 24 months preceding a sale, a founder's primary objective is to build a mathematical case to secure that premium valuation. Moving from a 3 times baseline to a 6 times multiple is not a matter of luck. It is a direct result of identifying and eliminating specific operational liabilities. Achieving a premium exit requires treating valuation as an engineered output, based on strictly controlled inputs, rather than hoping for a favorable appraisal. The single greatest threat to a company's overall valuation is founder dependency, often referred to as key person risk. If daily functions, like pricing, resolving guest complaints, or vetting new properties, rely solely on the owner's personal judgment, buyers will heavily penalize the valuation multiple. From a buyer's perspective, a founder-dependent company is viewed as a demanding, non-transferable job rather than a scalable business asset. The solution is depersonalization, the process of delegating core roles and establishing automated standard operating procedures so the business can function independently of the owner. This transition creates operational density, the ability to grow revenue without requiring a proportional, linear increase in headcount. Achieving a ratio of 1 staff member to 50 units requires a cohesive technology stack centered on a powerful property management system, or PMS, to eliminate workflow friction. This density proves to an acquirer that the company is a platform for significant growth, which directly justifies a premium EBITDA multiple. During the transition to financial verification, precise, audited financial statements become a non-negotiable requirement for any serious buyer. A common accounting error made by founders is classifying the homeowner's portion of the rent as company revenue. True company revenue must be defined strictly as management fee income plus guest and homeowner fee income. Tracking the cost of goods sold, or COGS, for direct services like cleaning or maintenance is vital for proving the profitability of ancillary revenue streams. Performance data is also scrutinized, specifically through key performance indicators, or KPIs, which buyers use to predict future cash flow. The churn rate, which measures the percentage of homeowners leaving the program, is a critical metric. A high rate signals a leaky bucket and underlying operational failures. Buyers also examine the take rate. A rate between 30 and 50% proves the company has successfully diversified its revenue beyond simple management commissions. Clean financials and consistently tracked KPIs transform a company's history from a series of claims into empirical, bankable proof of value. For companies managing fewer than 100 properties, the homeowner contracts represent the actual asset being purchased. These agreements must include an assignability clause. Without it, the company's core revenue stream cannot be legally transferred to a new owner. Vague or ambiguous contract terms create massive risk for the buyer and will be heavily penalized during the due diligence phase. This chart shows EBITDA multiples rising with enterprise size. While numbers set a baseline, qualitative factors shift your position. European STR multiples often compress to a 2.5 to 3.5 range due to regulation. Combat this by proving advantages like stable compliance and strong brand reputation. A high percentage of direct bookings is a powerful qualitative driver. It proves brand loyalty and reduces dependency on online travel agencies, or OTAs, like Airbnb or Booking.com. While financial data establishes the baseline valuation, the legal stickiness of contracts and qualitative brand strength convince a buyer to award a premium multiple. Selling a business is a multi-stage process that typically requires 6 months to a full year to finalize. This pie chart illustrates the transaction distribution by deal value, showing that the vast majority of sales in the short-term rental market fall within the sub-€5 million segments. Interested buyers will submit a letter of intent, or LOI. This is a preliminary, non-binding roadmap that outlines the price, structure, and a period of exclusivity for negotiations. Signing the LOI triggers due diligence, a forensic 60 to 90-day investigation by the buyer into the company's legal, financial, and operational claims. The reality is harsh. Up to 60% of M&A deals fail to progress or close, usually collapsing under the weight of this investigation. Successfully navigating due diligence is only possible if the 18 to 24 months of operational preparation were executed flawlessly. Founders mistakenly expect full upfront cash, but deferred payments or earnouts are the reality. As shown, 69% of earnouts are tied directly to future EBIT or EBITDA performance, with most payout periods lasting 6 to 24 months post-sale. Because a founder's final payout relies on how the company performs after they hand over control, vetting the buyer's competence is critical. Sellers must ask potential buyers about their post-acquisition growth plans and their specific transition strategy for staff and homeowner relationships. Due diligence is a two-way street. Securing your full valuation means ensuring the acquirer is capable of running the machine you built. The transition also has a legal reality. 96% of mid-market European transactions include strict non-compete clauses, typically lasting 12 to 24 months. Founders frequently face an emotional void when they step away from the business that served as their core identity. It is advisable to proactively plan for your next project, investment, or phase of life long before the deal officially closes. A premium exit is paved by building a scalable, system-driven, and financially transparent organization today. The most lucrative founders are those who begin with the end in mind, engineering the exact company they intend to sell tomorrow.